Hey there, guys. Congratulations on finishing chapter one. As we start chapter two, like I had said before, we're just going to be building on ideas that we came into contact with in chapter one. Um, and so to go into some of the review from chapter one, you guys were introduced to some things like the accounting equation. We had assets equals liabilities plus owner's equity, excuse me. And then you saw this line here, this T chart. We had assets on the left, liabilities, and owner equity on the right. You guys learned about transactions, and you saw what different types of transactions, their effect that they had on the accounting equation. So, for example, when Michael Delgado invested $2,000 into his company, we had assets increase. We had specifically the cash account increase by $2,000 because Michael Delgado put that money in, and we had owner's equity increase. You learn that each side needs to stay balanced at all times. Sometimes there's a transaction that affects this side, and they would be either going both up or both down, equal, always equal. Or sometimes we had transactions that only really affected one side, like assets, like when Michael Delgado spends cash to buy supplies. Those are both assets. And in that sense, cash goes down and supplies goes up. So you guys learned about transactions and their effect that they had. And you guys also learned about account names. And this is going to be important because it's going to show up a lot in this chapter. So account names like cash, supplies, prepaid insurance, any liability accounts, like any accounts payable, like if Michael Delgado owns some business money for supplies that he bought on account, or any owner's equity things like revenue, sales, or different expenses, things that impact only that owner's equity. So we're going to continue to build on this because this type of accounting, most businesses are too big to efficiently use an accounting scenario like that. So we're progressing on to looking at a journal. And so to get there, we have to introduce a couple more concepts that make accounting for these large businesses so much easier, because some large businesses would have up to maybe 100 different types of accounts. And so doing it this way is just a little bit too long. And so we need to refine it a little bit. So some of the terms that you're going to work with today. A T account is what we are going to set up in chapter 2. We are going to look at what T accounts are and how we can record transactions using T accounts. We are also going to introduce 2 words that are going to be important, and they're going to show up a lot, and they're going to be introduced just into the terminology of accounting that we're going to be using: debits and credits. So we're going to move on to saying you're going to do something like debit cash, and you're going to credit an accounts payable or something like that. So we'll get there, definitely, but we're sort of refining our understanding and building on what we learned before. Debits and credits, maybe you have heard those words before. Something like a debit card. A lot of you guys might have to go out and buy something from the store, buy movie tickets or whatever, get some restaurant food. You would use your debit card, and it just takes money straight out of your account. Credit cards are a little bit different. You're using somebody else's money. Those words don't apply to anything that we're going to talk about in accounting. So they're not the same. You kind of have to separate those meanings from each other. So in accounting, debits mean things that happen on the left side of a T account, and credits mean things that happen on the right side of a T account. So what does a T account look like? Up here, we have our accounting equation that you looked at in chapter 1, assets equals liabilities, plus owner's equity, split up into a left side and a right side. Separately, we have this thing called a T account. Again, debit means the left side, credit means the right side. In any T account, you're going to end up drawing some of these out. Well, you're not going to draw them out because you're going to be using the MindTap. They drew them out for you, but you're going to be working with them. And just know debits are always on the left. Credits are always on the right. All right. The T account, up here, you would have the account title. So you would have something like cash or supplies or whatever, but each account has its own T account. All right. So we're sort of going to build these T accounts into these sides over here. All right, so it's going to look a little fishy, but like I said, it needs to build this way in order to sort of refine our way that we record transactions. So getting on with that, just remember and go back into the textbook or this presentation if you need this, because the next image that I'll show definitely is going to be confusing right away. But stick with it. Like I said, once you start working with it a little bit, it'll make a whole lot more sense. So assets, we're sort of just breaking down our equation here. We have assets on one side, the left side, remember. The effect that debits have is that debits increase assets, always. Debits increase assets. So if you say you're going to debit a cash account, it means that you're going to be increasing cash. Liabilities and owner's equity, remember, are on the right side. And so those are always going to be credits that increase a liability account or an owner's equity account. This will make a little bit more sense once I can kind of visualize it for you on the next slide. One last term to notice here, and we're going to be working this when you do the work on your own or the work together end of lesson review, is this term called normal balance. And you'll see it when it comes up, but the normal balance is the side of the account that is increased, is called the normal balance. So the normal balance of a cash account is going to be the left side, because the left side is the debit side, and that is the side that increases. Vice versa on the liabilities and owner's equity there. So let's put a visual to all that stuff. All right. We have our accounting equation here. Assets equals liabilities plus owner's equity. You're familiar with that. We've looked at that stuff, and before you just had the accounts listed there and there. Now we're going to be working with it where each account is still going to kind of be on the left or right side for right now, but each account's going to have its own T account. All right. So again, there's our word normal balance, always on the left. Normal balance over on this side of the equation, it's always on the right. So one good way to remember this, and that's kind of what the previous slide was summarizing, but I wanted to wait until you had the visual in front of you. Cover up liabilities and owner's equity with your hand. I can't do that right now, but cover that stuff up for a second and just look at assets. So we have assets. We know that assets are on the left side of the accounting equation, okay? Debits and credits, always debits on the left, credits on the right. Debits on the left, assets are on the left, that increases. Okay, so assets are on the left side of the accounting equation. Debits are on the left side of a T account. Therefore, any asset, when you're talking about a debit, you know that you're going to be dealing with an increasing amount. Okay, now cover up assets on the left side and look at liabilities plus owner's equity. So any liability and any owner's capital account or any owner's equity account, like sales or expenses, is going to be just the opposite. So remember, liabilities and owner's equity are on the right side of the accounting equation. It's on the right side. Credits are also on the right side of every single T account. Therefore, liabilities and owner's equity on the right, any liability or owner's equity account you're dealing with, credits are going to increase those amounts. All right. So you're kind of breaking down what you were doing in chapter 1 when you were dealing with, like, what does the effect of Michael Delgado investing $2,000 of his own money into his company increases cash. So there, you know that you have a cash account here. Cash would go up and owner's equity would also go up. So to record that transaction, where you guys are going to end up getting to is you're going to say something like, when Michael Delgado invests $2,000 of his own money into his account, to record that transaction, we need to debit a cash account and we need to credit a owner's equity account. So we're maintaining that balance. And so again, it's the same principles from before. The accounting equation always needs to be balanced, always needs to equal one side and the other. As we go forward, we're just getting, like I said, a little bit more specific with that. So let's have a look.